that is from one transaction. In the sale of goods or services, in that goods or services, there is a cost and expense incurred in the production of goods or services. And actually, we call that cost of sales. So when there is a sale, there is a cost incurred for such sale. Expenses can be later on be recognized and incurred separately as part of operating expenses. But here, when we mean expenses here, is actually included here costs and expenses. So these effects to this equation can be rooted from one and the same transaction. There could be a separate transaction with regards to incurrence of expense, selling expense, operating administrative expenses. And in that case, it could only be a decrease in asset, an increase in expense. Now, as we proceed, we will be reaching that part about this plus addition, subtractions, additions, okay? The normal balance, the debit credit rule, and the normal balance rule. So that's on the next succeeding slides. Okay, so I think we are done with this. You can reserve your questions later on. Then let's proceed to the next slide. There are combinations of increases and decreases, different combinations. There are other combinations. The key in analyzing business transactions and determining which of the elements will be affected is knowing the equation that it should always be balanced. That is why a journal entry, which you will, of course, what is this is journal entry, you will learn in a separate topic, should always have a total debit entry that is equal to a total credit entry. Because the equation must primarily always be balanced. And you have determined already correctly that at least one of the elements will decrease or increase or decrease. So it's very important that in the analysis of the transaction, you have to determine which of the elements will increase. And it's not, as I've said, not difficult, because when we, example, speak of acquisition of asset, certainly we can conclude that there is an increase in the asset. So asset is on the left side of the equation. Certainly, if there is an increase in the asset, knowing that already, and we are sure of that, by further analyzing the transaction, we can determine which of the other elements is affected by such transaction. So we already have a stepping stone. So it's very important to determine that stepping stone as if like a foundation that will grow as you analyze and be able to complete the analysis of the transactions and be able to determine the complete combinations of increases or decreases. We will use this technique later on, and as I already tried to share with you, on when we come to specific business transactions. So let's proceed to the next slide. Okay, this is now the normal balance rule. The normal balance of an asset is what I mentioned just a while ago, a minute ago. The normal balance of an asset, a liability, and owner's equity, and the accounting language for it. Now, this normal balance is very important in determining knowing on what should be the entry in terms of debit credit entry in increasing a particular asset, liability, or honest equity account. Now, account is again a terminology in accounting, a specific accounts. In the process of processing that transaction, a data, so a transaction provides a data. This data, transactions from data coming from transaction must be transformed into a summarized accounting information. And the summary tool being used by the accounting world, accounting profession, accounting discipline, are this debit credit. So as you can see, there is no other third side here. So there are only two sides, a debit side and a credit side. In the equation, there are also two sides. We can call this the layman's term, left side of the equation, on the right side of the equation. In accounting, we use a term or a language for it we call debit side and a credit side. Now, this debit side of the equation, which refers to the assets being on the debit side of the equation, so must have a normal balance of a debit. So an asset in the summary process of this summarization process of this transaction, the data taken from the transaction, as we already learned that this data affects, or this transaction affects the variables, whether it will increase, decrease these variables, these elements. Now, the accounting uses, as we already said, a language, debit and credit. Now, this debit side of the equation, the assets, being on that debit side of the equation, the assets having also these two sides, a debit side and a credit side. So in terms of increases or decreases to these assets, we will use a term debit or credit. So maybe you will ask, why is it that the accounting does not use to be more understandable, increase or decrease? I don't know, but we learned that it's called debit and credit. Now, increase or decrease, I think the reason for that is that's why the accounting profession, accounting discipline, does not use increase or decrease, because as we go to the other side of the equation, an increase in liability could be on the credit side. So it does not necessarily mean that a debit is always an increase or a credit is always a decrease. With regards to assets, an increase is recognized as debit. A decrease is recognized as credit. And mathematically, we learned that if two variables have the same signs, like positive signs, the variables having the same positive signs, the operation in mathematics is addition. So the example, 1 plus 1, 1 positive plus positive 1 is, the operation is an addition. But if one of the variables, 1 plus negative 1, one of two variables having a different sign, the operation is transformed into a subtraction. And I think that is a representation of the realities in life. Like in terms of colors, if we add two the same colors, red and red, the operation there is, of course, an addition. But if we add red and a different color, the result is not anymore red. So there is a process of subtraction there. So I think that's how I can explain why is it that increases in assets are recognized as debit and the operation is addition. Assets being on the debit side of the equation and assets being on the debit side, the increase in asset, therefore, increases in assets must be debited. So here, for example, we have 100. This could be, for example, an investment by the owner to the business. So the owner invested 100 to the business. The asset will increase. It should be recognized as a debit to increase such asset. Then there is another transaction here, an increase in the asset. So here we have a total of 150. A credit, a decrease in the asset, like payment of cash, is recognized as credit. So this is the balance. We call this the balance. 150, total of the debit, minus total of the credit, is the balance of that particular variable asset. Now, I mentioned a while ago about accounts. Now, these assets could be, as a tool in accounting, we have this account. So accounting, the word account. So there are different accounts or different forms of assets. And in accounting, that is assigned with account names. So in accounting, in the accounting system, part of the design of the accounting system are these different accounts. Example, cash. Cash is an asset. So particularly, so generically, it's called assets. Specifically, we have cash as a specific asset. So cash account. So later on, as we proceed, also again, we will be able to show. I will be able to show to you these different accounts, some of these accounts. Now let's go to the other side of the equation. We have liabilities. Liabilities is on the credit side of the equation. So being on the credit side of the equation, increases in liabilities should be recognized and recorded as credit. So in the transaction, if we have determined that there is an increase in the liability, that particular liability and the corresponding amount should be recognized with regards to its effect to the equation as credit. Example here, we have 50, assuming that the business accounting entity borrowed money. So there is an increase in the asset, but also a corresponding increase in the liability. So increase in the asset is debit, and increase in the liability is credit. So both variables increase. So on the other side of the equation, liability, it is recognized as credit. Now, here we already have seen that Debits does not necessarily mean that it is always an increase, because on the other side of the equation, credit is an increase. Liability can be increased by crediting such particular account and the corresponding amount, recording that in that particular amount as credit. And this is because of this normal balance, the debit side and the credit side. Now again, you will ask, how come that the left side is debit and not the credit, and on the other side, this is the debit, the credit and not the debit? There must be such kind of stability here. So I think the answer for that is the stability. If the foundation is not stable, everything will crumble. So for purposes of stability, it is provided that the left side is the debit side and the right side. But of course, if you are facing on the mean, not the, I don't know, but this could be the credits. But again, it is the issue of the stability. It's the issue of the stability of the foundation of these concepts. So that's why there is no argument anymore, I think, whether this is the credit or this is the debit or vice versa. So we had to have some stability, and we make this side a debit side and we make this the credit side. And the same explanation with regards to the owner's equity. Increases in the owner's equity, as shown by this, is recognized as credit. Decreases, which is an opposite sign, is recognized as debit. So the opposite of increase is decrease. So the opposite of credit is debit in accounting parlance. Okay, let us now proceed to the next slide. It's still about the normal balance of an asset, of the variables, liability, owner's equity, and the accounting language for it. I think I already discussed this. The assets being on the debit side of the equation should have a debit balance. Thus, increases in an asset should be recorded as debit, and decreases should be recorded as credit. And I think I also try to illustrate about this cloud quote. This rule is very much, o medyo may kulang, rooted in the realities of our life and proven by mathematical computations. So mathematics, there are stories behind this mathematics. So, sabi nila mga numero, kwento sa likod ng numero. So there is a story behind these accounting figures. That's why in accounting we call this book of accounts, book. We write the story of the business in the books, accounting books. And the story of the life of this business is translated into figures, into numbers, for better decision making. So it's better to decide if we base our decisions on the circumstances of our life, but translated into numbers. Now we proceed to the next. Liabilities and owner's equity, being on the credit side of the equation, should have a normal credit balance. Thus, their increases should be recorded as credit. Decreases should be recorded as debit. It is clear that this is the other side of the equation. It has an opposite reality. The credit becomes the increases. It must also have a different name called credit. So two sides with different name. Of course, if we don't have a different name, how can we identify? Just like we have names to identify. Names. Okay, let's proceed to the next slide. This is still about the normal balance, but here we have here the expanded side of the owner's equity. We call the expanded accounting equation, and their corresponding normal balances. So let us now discuss this. Investment is about the capital inflow from the owner to the accounting entity. So there is an increase in the owner's equity. Capital investment by the owner to the business increases the owner's equity. So the sign is positive. Increase. It's an increase. So the normal balance of an investment account or an investment variable element of the expanded equation should be credit because it increases the owner's equity. Owner's equity is a normal credit balance. So to have a process of addition, increase, there must be the owner's equity and the investment account, which affect the owner's equity, must have the same sign, a credit sign. So increases in investment increases the owner's equity, must be recognized and must have a normal balance of credit also. And having a normal balance of credit increases in investment must be recognized as credit. So here we have 20. This could be the investment by the owner. So to increase such owner's equity, we credited, we recognize that 20 capital investment as credit. Ito namang 3 na to, this could be the in the accounting process, we have this closing of this could also be additional investment, but you will learn later on that this could also be because of closing procedures, closing entries, wherein the revenue and expense are being closed to the investment account. So anyway, you will learn this in the, I think, succeeding topics about closing entries. Now let's go to drawing. As you can see, as we already discussed previously, a drawing is a withdrawal of the capital or interest by the owner. This is a variable that decreases the capital invested by the owner or the interest of the owner in the business. Now, this is a transaction wherein the owner of the business takes assets, maybe in the form of money, gets assets or takes away assets from the business. So the owner is a separate accounting entity. As an accounting entity, the owner is a separate accounting entity of the business. But why is it, sir, that we have this owner term in that accounting entity? This is the accounting entity. It has assets, liabilities, and these different variables. Now, that accounting entity, the business, it could either be in the form of sole proprietorship, as you already mentioned, partnership, or a corporation, must recognize in its books or accounting his obligation. So actually, the business, the accounting entity, having an obligation to the owner to return the capital. So that must be properly be accounted and be recognized in accounting as the interest of the owner. So going back to the equation, the assets of the business, to further explain this, can be claimed by two interest claimants: the creditors, represented by the liabilities, and the owner. So two claimants of the assets. the liabilities, creditors, represented by these liabilities. So we don't call it creditors, but liabilities. So in the point of view of the accounting entity of the business, obligation. So he has an obligation to creditors called liabilities. When the accounting entity or the business borrows money, so increase in asset, correspondingly, it must recognize his obligation to creditors by recognizing it here in liabilities. So claimants, interest, the interest of the creditors and the interest of the owner. So if the owner decided to take away that interest, he can involve himself in a drawing transaction or withdrawal transaction. And by such withdrawal or drawing transaction for personal use, he will take away money or assets from the business for his personal use. So that's why it's a deduction, subtraction here. And being a subtraction, a deduction from the normal, with these variables with the normal credit balances, the normal balance of a drawing must be debit. So to arrive at the process of subtraction in mathematics, having two different circumstances, this is a deduction of the investment. So therefore, the normal balance of a drawing account must be debit. That's why here, the increase in the drawing is recognized as debit. Eh, sir, bakit hindi nilang nilagay dito decrease sa investment? Bakit nakita pa? How come that we still have to show and create another variable called drawing? Now, accounting provides information. So to be more informative, so that we can separately show how much capital invested or interest of the owner has been drawn by the owner for personal use, we create a separate variable for that. If we will just incorporate this 5 to this investment variable, it will be lost in translation. So the readers of the financials of the equation of the financial statements, summary of this data as accounting information, the reader or the user of the information will not be able to know. If this drawing amount is very important to him, he will not be able to know because it will be lodged here, incorporated here, and summarized into the balance. So by creating a separate variable for this drawing, it is clearly shown by this equation. Later on, you will learn this equation as the balance sheet, financial position. It will clearly show that information by creating a separate variable. So let's proceed to the next. This is revenue, then the expenses. As we already learned, this is about a transaction. Here, sale of goods or services. Here, incurrence of costs and expenses. A revenue is a transaction that increases the owner's equity. So when an accounting entity, a person, a sole proprietorship business, a partnership, a corporation, sells goods or services, he earns something. The accounting profession, accounting language, accounting discipline recognize that effort as revenue. But of course, we have the transactional revenue, the revenue transaction to be complete. There must be sale of goods or services. In that sale, there must be delivery of goods or services. Even in the under the law, there is sale generally as a rule if there is delivery of goods or services, transfer of ownership from the seller to the buyer. The accounting entity being the seller, transferring the produce to the other persons in the form of sale transaction. So in life, it is not enough that we have efforts. Our efforts must be translated into the benefits of the others. So an effort that is only for up to the point that we don't translate it for the goods, for the good of the society, of the community, good of the others, is useless. That's a useless effort. So life is useless if we will not use this for the good of others. So sale of goods and services. That sale, that effort, production, then ultimately being sold, these goods being sold to the buyers of that accounting entity, we recognize as revenue, that is an increase in the owner's equity. So our efforts, ultimately sale of those efforts, of those goods, services, increases our equity. I think even the good book, I'm referring to the Bible, with regards to the parable of the talents, when God judges those people who do not use their talents, and versus those people who use their talents for the good of others. So, okay. Then this expense, of course, is a deduction of revenue. The earning of revenue, in the process, we incur expenses, and these expenses reduces such revenue. We have to recognize such cost and expense. So benefits and cost. Benefit being the revenue, cost the expenses. So it should be on the debit. A normal debit balance, and increases being on a normal debit balance must be recognized as debit. Let's proceed to the next. This is just the written discussion. The investment increases the owner's equity, and being on the credit side of the equation should have a normal credit balance. Thus, its increases should be recorded as credit, decreases should be recorded as debit. Then the drawing, although it's on the credit side of the equation, it decreases the owner's equity. Therefore, it should have a normal debit balance. Thus, its increases should be recorded as debit, decreases should be recorded as credit. Then the revenue. The revenue increases the owner's equity, and being on the credit side of the equation should have a normal credit balance. Thus, its increases. Next, expenses. Although it's on the credit side of the equation, it decreases the revenue and owner's equity. Therefore, it should have a normal debit balance, have that process of subtraction. Thus, its increases should be recorded as debit, decreases should be recorded as credit. Now, of course, it will take a while for you to master this normal balance rules, debit credit rules. But by practice, I think you have some textbooks that you use, reference. You better be not be lazy or be industrious in answering those different transactions, and ultimately you will arrive at that complete accounting cycle, steps in the accounting cycles, and it's very I'll call this good that you will be able to complete that. So you will be able to prove that you can do it, and it's a good think that you will be able to do it and be able to complete the cycle and arrive at a correct financial statements. Of course, you will learn this later on, these financial statements in another topic. Next, here, this is now the start for us to specifically analyze business transactions. But as preliminary for that, we have to define what is a business transaction. So this is the topic about how a specific business transaction increases or decreases the variable elements of the accounting equation. So we are now going to that last part of this course, wherein we will now deal with a specific transactions with corresponding values and amounts, of course, and analyze those and determine its increases and decreases to the variables of the accounting equation. So, definition of business transaction. A business transaction is an event of exchange of goods and services or quantifiable by monetary value between two or more accounting entities. So, speaking of exchange of goods or services, it's really about sale transaction. There is a transfer of goods or services from one entity, one person, to another person. And that transfer must be quantifiable in terms of monetary values. So money as a medium of exchange. But of course, we also have this Bitcoin, but the legal tender under the law is still peso or other currencies recognized by our law as medium of exchange in our economy here in the Philippines. So here in the Philippines, we are talking of peso, primarily peso. So we quantify our transaction, we quantify the effects of these transactions to the variables of the accounting equation in terms of monetary value. So just like your performance in the class is translated into numbers, figures, to determine whether you pass or you fail. We compute your grades. In preparatory levels like toddlers or kinder or those schools for the children, they don't have this grades in terms of figures or numbers. What they have is like awards, most behaved, best student. So it's quite difficult to determine they find still difficult to translate the performance of a child, of a kindergarten student or a preparatory student in terms of numbers in mathematics. But I think it can be done. It can be quantified. Values can be determined. So again, a business transaction is an event of exchange of goods and services quantifiable by monetary value between two or more accounting entities. So it could be a transaction wherein a sale is not only to one person, by seller to one buyer, but it could be by one seller to two or more buyers, or by one buyer from two or more sellers of goods or services. But of course, sa barbershop, hindi naman pwedeng sabay-sabay na dalawang barbero o tatlong barbero ang gugupit sa isang customer. But of course, in acquisition of goods like merchandise, like cement, the buyer can acquire from two or more different sellers at the same time, like in an online transaction nowadays. Okay. By just a difference of seconds or minutes, you can purchase goods from two or more different sellers or vendors. Now, this is very important here. There is always a value received and a value parted with every business transaction. If you are using Passion's book, Passion, Accounting 1, book by Passion, Passion discussed this value received and value parted with in every business transaction. I remember my Accounting 1 in college, our teacher teach us to analyze transaction using value received and value parted with. But I think the lesson here is in every transaction, a business transaction, you have to understand that there is such a value received and a value parted with. And that is again the realities of life. Every day of our life, we receive something and we parted with something. In our relationship with others, in a relationship between a boyfriend and a girlfriend, a husband and a wife, there is such a give and take relationship. In a relationship between the government and its constituents, and its citizens, and its people, there is a give and take. We call that in taxation symbiotic relationship of protection and support. So, in a business transaction, the seller, the accounting entity we're accounting for, receives something like cash sale, he receives cash. And he parted with something, the product or the goods that he sold. So value received cash and value parted the goods or services, the cost of the goods, and physically the goods that he sells or sells to the buyer. Now, you can also use this in analysis of increases and decreases in the accounting equation to the variables of the accounting equation. By the way, it's quite, I will try to emphasize, increases or decreases in the variable elements of the equation, not increases or decreases to the equation. Because equation is composed of these variables. Asset equals liabilities plus owner's equity. So it's, I think, in politics correct to say politically correct or specifically correct to say, okay, that increases in the variables or elements, not increases in or decreases in the equation. And later on, we're more specific, increases or decreases in the accounts of these different variables or elements. So variables of this accounting equation have more specific accounts. So increases or decreases to the accounts of the variable elements of the accounting equation. Let's now come to the classifications of business transaction. Now there are 4 classifications here: source of asset transaction, use of asset transaction. This is also important because by knowing that a transaction could be a source of asset, a transaction that is a source of an asset means the asset will increase. So you have to analyze the transaction by determining whether this transaction is a source of an asset, which means the asset of the accounting entity will increase. the transaction being a source of an asset of the accounting entity. Then we also have this use of an asset. Use of the asset of whom? Of the accounting entity. So the use of the asset of the accounting entity decreases the asset of the accounting entity. So in the analysis of the transaction, you have to know whether a transaction decreases the asset of the accounting entity we are accounting for. So use of asset transaction, a transaction where asset decrease with a corresponding decrease on the other side of the equation. Going back to the equation, or you can picture it in your mind, asset decrease is one of the debit side, or is the one side of the equation. To balance the equation, there must be also a corresponding decrease on the other side of the equation. Of course, you have further determine which of those variables or accounts on the other side of the equation. Then we also have this exchange of asset. There is a corresponding decrease. There is a decrease in the asset, while another asset also increases. We already illustrated, like for example, acquisition of asset by payment of cash. So acquisition of an equipment, for example, equipment as an asset will increase, but cash, by paying cash, cash will decrease. Cash is an asset. Then there is what we call exchange of asset, which summarily there is no effect on the other side of the equation because the effect is only on the asset sides. An increase in one of the asset and another kind of asset decreases coming from that same transaction as a result of that one transaction. Also, payment of non-cash assets. So acquisition of asset can also be paid with non-cash asset. Barter, that is nowadays very prevalent. Barter, online barter. Then we also have here exchange of rights and obligation. Exchange of rights and obligation affects only the right side or the credit side of the equation. A decrease in the liability with a corresponding increase in owner's equity, or vice versa. So we have here novation of obligation. You will learn this in your course Obligation and Contracts. A liability transformed into another form of liability. Example,